Nobody warned you. Not the headlines, not the evening news, and certainly not the comfortable voices on television who specialize in telling you that everything is fine. They did not warn you in 2008. They did not warn you in 2020. And they are not warning you right now as the architecture of the global monetary system begins to fracture. On May 15th, the most powerful financial seat in the world changes hands. The man taking over will control a $6.7 trillion Federal Reserve balance sheet, and the decisions he makes next will dictate the survival of your savings. We are entering a transition window where the old rules are loosening, but the new rules have not been written yet. If you are someone who has spent your whole life saving, doing everything right, only to watch the system quietly loot your purchasing power, make sure to hit the subscribe button and give this video a thumbs up, because we update the truth of this market every single day, and what I'm about to show you is the exact mechanism they are using against you. Here's the reality about a $39 trillion national debt. You don't just pay it back, it's a mathematical impossibility. We crossed the event horizon of sustainable debt years ago. Right now, our gross national debt compared to our gross domestic economy is sitting past 120%. The cleaner number, public debt held outside the government, just crossed 100% this year for the first time. Whichever metric you choose to look at, it's terrifying. The last time the United States was even remotely close to these levels was in 1946, right after the end of the Second World War, when that ratio hit 106%. Now back then, the government didn't formally default, and they certainly didn't try to tax their way out of it, because doing either of those things causes a sudden violent political revolution. People riot when you take their money directly. So instead, they ran a quiet 28-year playbook. By 1974, that massive debt load had magically collapsed all the way down to roughly 25% of gross domestic product. How did they do it? They didn't invent some miraculous new technology to grow the economy fast enough to outpace the debt. They used a mechanism called financial repression. It's a highly sanitized bureaucratic term for what is fundamentally a bloodless wealth transfer from the working class to the sovereign. They held interest rates artificially low, completely pinned to the floor by central bank mandate, while they let real-world inflation run hot. If you were a middle-class saver in 1950, you might have been getting 2% on your bank deposits, but the actual cost of living was rising by 5 or 6% a year. Every single year, you were losing 3 or 4% of your purchasing power. There's no line item on your bank statement that says wealth confiscation. There's no tax bill that arrives in the mail to warn you. You just wake up one day a decade later and realize that the money you saved to buy a home can barely buy a decent car. It's the boiling frog phenomenon. The system relies entirely on your cognitive dissonance, your innate desperate desire to believe that the numbers on your screen are real, to pull it off. They liquidated their wartime debt by liquidating your future. Now you might be thinking, this time is somehow different. It isn't. The data is already bleeding through the government's own official ledgers. Consider what happened on the morning of the 12th of May. The Bureau of Labor Statistics released the April Consumer Price Index. Headline inflation rose 0.6% for the single month and 3.8% on a trailing 12-month basis. That's the hottest annual print since May of 2023. But the figure that should have stopped the nation cold was buried deep inside the technical appendices, printed in the dry language that governments prefer precisely because it discourages average citizens from reading it. Real average hourly wages fell 0.5% in the single month of April and are now down 0.3% on the year. The average American worker is officially losing purchasing power. Not in theory. Not in the speculative projections of some doom and gloom podcaster. On the government's own tape, formally, in writing, you're getting poorer every time you clock in for a shift. Place that grim reality alongside the energy component of that exact same report. The Bureau of Labor Statistics confirmed that the energy index rose 3.8% in April alone, accounting for over 40% of the total monthly increase. Gasoline is up 28.4% year on year. Fuel oil is up 54.3%. Airline fares are up 20.7% in 12 months. These aren't rounding errors. This is the brutal arithmetic of a global energy market that's breaking down. We're dealing with a Strait of Hormuz that has been effectively closed since late February. Before this current conflict, approximately 20% of the world's traded oil transited daily through that narrow choke point. Now, Saudi Aramco's chief executive has been incredibly explicit. The market is losing approximately 100 million barrels of supply each week, and normalization won't occur until 2027. West Texas intermediate crude futures are settling above $102 per barrel. Brent crude is holding near $107. The ceasefire with Iran is, in the exact words of the President of the United States, on massive life support. The supply chains that keep the modern world turning are fracturing. This is the chaotic, inflationary environment into which the Federal Reserve is executing a massive regime change. A Federal Reserve chair changing isn't just a news headline. It's a fundamental shift in the rules of gravity for money. The man stepping into the chairmanship on the 15th of May, Kevin Warsh, just walked into the Senate Banking Committee and laid out the architecture of what comes next. And there's a dark psychological twist to how they're running the playbook this time. Warsh explicitly told the committee he isn't a fan of forward guidance. He's effectively ending it. If you aren't familiar with the term, forward guidance has been the Federal Reserve's primary tool for the last 15 years. It's the practice of spoon-feeding Wall Street, telegraphing exactly what the central bank is going to do with interest rates months in advance. It was designed to keep the markets calm, to remove surprises, to hold the hand of institutional investors. Taking that away isn't just a minor administrative shift. It's a weaponization of psychology. Think about what happens when you remove the training wheels from the most heavily leveraged financial system in human history. Less signaling means deliberate, engineered volatility. Every single economic data release, every consumer price index print, every jobs report becomes a high-stakes guessing game. The market will violently reprice itself every time a piece of data hits the wire because no one knows what the central bank is actually thinking anymore. And why would they do this? Because volatility is the ultimate tool for shaking weak hands out of their positions. When a paper market swings 20% in a single trading session, the average retail investor panics. They look at the red on their screen, their stomach drops, and they hit the sell button. Who do you think is buying when they sell? The institutions, the insiders who understand the direction of travel? That panic isn't an accident. It's the system clearing the board, shaking you out of your assets before the real repricing happens. And this regime change is colliding with an inflation print that's forcing the futures market to panic. Within 60 minutes of that hot 3.8% inflation release, futures traders abandoned any expectation of rate cuts this year. They're now pricing over a 70% probability of a rate hike by April of 2027. We're looking at a two-chair Federal Reserve dynamic, with Jerome Powell staying on the board and an incoming hawk like Warsh taking the helm. If the Federal Reserve's next move is tighter rather than looser, it will validate the monetary case for hard assets with a force that accommodative policy never could. And this is exactly where the paper illusions violently collide with physical reality, and why you need to pay very close attention to what's happening underneath the surface. While the masses are distracted by the monetary theater, by the daily fluctuations of the stock market and the political circus, the structural foundation of the global economy is quietly running out of materials. We're talking about silver. And I don't mean silver as a line on a chart or an exchange-traded fund you trade on your phone. I mean silver as an unavoidable physical element required to build the modern world. You can print $1 trillion on a keyboard at the Federal Reserve, but you can't print an ounce of physical silver. You can't construct a high-efficiency solar panel, you can't build an electric vehicle, you can't manufacture a semiconductor, and you certainly can't build the massive data centers required for artificial intelligence without it. It's the most electrically and thermally conductive metal on the planet, and there's no cheap substitute. The Silver Institute, which is the industry's own research authority, is an organization entirely allergic to exaggeration. They deal in dry institutional data. Yet, in their latest annual release, they formally declared that silver has entered an era of reduced stocks. That's a polite, highly bureaucratic way of screaming that the global vaults are emptying. They project a global silver market deficit of 46.3 million ounces this year. That makes it the 6th consecutive annual structural shortfall. For 6 years, the world has consumed vastly more silver than it has pulled out of the ground. Since this cycle began, we've run a cumulative deficit of 762.1 million ounces. Approximately 23,700 tons of silver that existed in commercial and investment stockpiles 5 years ago has been consumed, allocated, or absorbed. It's gone. It hasn't been traded, it has been consumed. It's been melted down, placed into solar panels, and bolted onto rooftops where it will never return to the monetary supply. To make matters worse, you can't just flip a switch and mine more silver because the price goes up. Roughly 74% of all global silver production is completely incidental. It's a byproduct of mining for base metals like copper, lead, and zinc. A massive mining conglomerate doesn't change its 10-year extraction plan for a copper mine just because silver spiked $20. Silver-specific price signals don't dictate the supply chain. And against that already incredibly constrained supply picture, look at what's happening geopolitically. Peru is the second largest silver-producing country on the face of the earth, responsible for almost 14% of global mine output. Just days ago, they issued a formal national energy emergency decree. Their domestic energy grid is failing. You can't run heavy mining equipment, mineral processing plants, and international logistics networks on rolling blackouts. This is a massive supply-side fracture, arriving right on top of a deficit that was already tearing the market apart, and the financial media is completely ignoring it. If you want to know what this looks like when the dam finally breaks, look at what happened in London in October of 2025. The London Bullion Market Association is supposed to be the bedrock of the global physical silver trade. They claim to hold hundreds of millions of ounces in their vaults. But when industrial demand tightened, the truth came out. Of the 884 million ounces they held, only roughly 150 million ounces, about 17% of that massive stockpile, was actually operationally free for delivery. The rest of it was encumbered. It was leased out, rehypothecated, pledged as collateral, or already allocated to someone else. When the market realized the physical metal wasn't there, the 1-month London silver lease rate, which is essentially the cost to borrow the physical metal, exploded from 1% to over 30% in a matter of weeks. That isn't a market functioning normally. That's a market that peered over the edge of an abyss. They managed to paper over it temporarily, but the underlying arithmetic hasn't changed. People like to compare this to 1980, when the Hunt brothers famously tried to corner the silver market. The regulators simply changed the rules, raised the margin requirements, and crushed them. But the Hunt brothers were just two billionaires playing a speculative game with paper contracts. You can crush a speculator. You can't crush the physical laws of thermodynamics. Today, the entities demanding physical delivery aren't speculators looking to make a quick buck. It's the global military-industrial complex. It's the world's largest technology companies. They aren't going to settle for paper cash settlements when they need the physical metal to keep their assembly lines running and their defense systems operational. And the big sovereign players know this. Look at what the President of the United States is doing right now. In 36 hours, he'll land in Beijing for the first American presidential state visit to China in nearly 9 years. He's carrying into that summit a shattered ceasefire, a closed oil strait, and a technological war over artificial intelligence. China is, by any reasonable accounting, the dominant player in the physical silver market. They hold the physical inventory, and they hold the upstream rare earth export leverage. What emerges from those rooms in Beijing on the 14th and 15th of May will have consequences for the silver market that none of the consensus forecasts have attempted to model. The institutional money is already quietly moving. The Sprott Physical Silver Trust holds over 216 million ounces of fully allocated, unencumbered silver. Russia has formally incorporated silver into its sovereign precious metals reserve program as a strategic store of value. This is the first major central bank reclassification of silver in modern monetary history. The World Gold Council showed that 95% of central banks now expect global gold reserves to rise, and Bank of America, in its published target architecture, places the upper bound for silver at $309 per ounce. That's roughly 265% above where it trades this morning. These aren't the coordinates of a market that has already priced in what's happening. These are the coordinates of a market that is still doing the arithmetic. So where does this actually leave you? The Great Transition is not some abstract event looming in the distant future. It is already here. Eras in financial history do not resolve neatly in a single fiscal quarter. They resolve across long, grueling cycles, and they tend to compress suddenly and violently at the exact moment of maximum inattention. The people who survived and thrived during the 28 years of financial repression after the Second World War were not necessarily the smartest people in the room. They were not the fastest day traders, and they certainly were not taking their investment cues from the comfortable voices on television. They were simply the individuals who understood the mathematical direction of travel. They recognized that the paper game was mathematically breaking, and they positioned themselves in hard physical assets before the rest of the herd even woke up. The greatest wealth transfer in modern history is happening right in front of us, quietly encoded in the dry, boring language of government labor reports and structural mining deficits. If this changed how you see the architecture of the system, subscribe and leave a comment below telling me exactly what you are holding right now.